Good evening, welcome to Tonight with Bruce Whitfield. It's a special broadcast tonight, recorded earlier today at the JSE. We invited a bunch of brokers into the auditorium at the JSE to meet a guy called Chris Freund. Chris Freund manages a lot of money at Investec Asset Management, about 110 billion rands worth. It's what he's ultimately responsible for. Do they let people who use BlackBerry smartphones still manage that amount of money?
Bruce, that's an unfair opening question.
It is an unfair opening question, but do you not need to be like snappy and quickly and zippy with the times?
No, it's a longer term process, Bruce, and I must be about the last person in the world still using a BlackBerry. But nevertheless, I feel I'm supported by enough smart people that it'll all be fine. Thank you.
Leon Kirkenes used to use a really old analog phone, and look what happened there. But let's not go there. Give me a sense, please.
It's not going well.
The world is full of value investors. It's the most popular thing since the Banting diet. Give me a sense of value investing, because you've got some very strong value investment culture within Investec. I know it's not your particular field, and then I want to get onto your philosophy. Why is value not giving value?
Well, look, you can understand intuitively why value investing is appealing. Sort of telling your clients you're going to buy low and sell high. I mean, what could be better than that? And you study at university or in the CFA, you will study, classic valuation techniques, forecasting free cash flows back to today's, value, and that's it. So it all works well in theory, and there are a lot of people in South Africa who subscribe to this methodology. But from that point to actually operating it in practice is a big leap. And just some of the pitfalls or potential areas that can go wrong is, first of all, deciding what is the value for anything is quite tricky. Mm-hmm. The sort of academics would say you forecast the free cash flows coming from any asset, and then you discount that back to today. Now, do you know how much subjectivity there is in forecasting any cash flows into the sort of horizon, into perpetuity? I remember working on both sides of a deal, and I could come up with this sort of, as corporate finance teams do all the time around the world, come up with wildly different valuations that are entirely justifiable depending on which side of the fence and which is their client. So I want to say, don't get too hung up on calculating that this glass is worth exactly 100 rand. The best you can do is if you think this is worth 100 rand, it's maybe worth somewhere between 80 and 120 rand.
At various points in any cycle, you will pay anything between 50 and 150 for the blooming glass, won't you?
Correct. Okay. So you also need to have a great deal of patience if you're a proper value manager. Now, I personally don't have the DNA. That's just not the way I'm wired. But there are some very good value managers in South Africa.
But if you are a value manager and you buy low and you sell high, you've not been able to do particularly much in the last 5 years other than buy resources. And we know what's happened to resources in the last 5 years. They've destroyed a lot of value, which is the risk of having been a value fund manager since the market started recovering.
Right. Look, we shouldn't be too harsh on value managers, because probably just when we've consigned them to the sort of the bin, they will strike back with vengeance.
That's what they're hoping to.
Yes, agreed. Yeah. But listen, you touched a nerve there when you said resources and value, because to me those two you can't use in the same sentence.
But they're cheap. Come on.
But it's absolutely irrelevant.
Go buy an ore. It gets cheaper every day.
Irrelevant. The valuation of a resource company, of a commodity share, whether it's cheap or not, is I want to sort of push the envelope and say it's completely irrelevant. I don't really mean that. But what I mean is that if a share is cheap on, let's say, a price-to-book basis, because there's no E right now, so on a PE basis it looks very expensive. But let's just say on a price-to-book or something like that, it looks cheap. Whatever the underlying commodity price is, whether it's gold or coal or copper or iron ore, if that goes down, then your perceived cheapness is not going to save you. It's going to get cheaper. So I think the valuation is the very last thing you should look at when you're evaluating sort of whether to buy or sell commodity shares.
When you look at the commodities complex, though, everything from copper to iron ore to gold to platinum to oil, over the last 6 months have been in a continuous slide. There's been very little respite.
Correct. And so that's my point about this perceived cheapness of, say, Anglo-American hasn't saved you at all. So then you have to take a view, what are the big drivers of that slide in all the commodity prices, and clearly it's China. The global market itself, the global economy itself is actually not in too bad shape. Certainly US is actually quite hot. But the big buyer at the margin is China, and China's going through a big property slump, and that's why the commodity prices are falling.
But at some point, commodity prices stop falling, they start rising, and shares started rising 6 months before. So how do we, and how do you particularly then, as a non-value investor, go about making investment calls in a market which is at historically very high levels?
There you touch on another issue, the valuation of the market generally. Okay, so here's where I take issue with a common refrain amongst investment managers in South Africa is that the South African equity market looks terrible and is overpriced, but the global markets are fine. Okay, so I say that's not entirely a consistent. Yes, South African markets are, valuation is slightly worse than global markets, but it's highly unlikely that you'll see South African shares take a bath at the same time that you do absolutely fine in your global equity portfolio. There's just too much correlation between equity markets around the world. So that's the sort of the first overriding point I'd make about that. The second thing is, look, I've said to you, we're not a value. I'm not a value manager. The core process at Investec is not value driven. We do have a value proposition, but it's not the sort of core process. So what is it that we believe in? Going back to your commodity question, we will look at the expected changes in earnings. All right. So our view is that any company today, the share price, if you pick up the business day and you look at the share price, that share price reflects what the consensus thinking is about the earnings for the next and cash flows for the next couple of years. Now that may be very strong, like plus 30 or something for the next couple of years, or it might be minus 10 for the next couple of years. It doesn't matter. If it's minus 10, the share price will be low. If it's plus 30, the share price, the valuation will be high. So what we look for are changes at the margin in whatever those consensus expectations are. Now, two ways we can do this. One is we've got a whole battery of analysts back at the ranch who sort of squirrel away and actually try and come up with sort of particular insights which the market hasn't got. And secondly, we just look at what is happening. And what I mean by that is that once you start to see a company, Discovery, for example, once the sort of investing community start to revise upwards, whatever they think Discovery is going to earn, let's say it's 20 was their base case, 20% earnings growth, and it goes to 22, 25. Then there's a very high probability that upward earnings revisions will continue. And those shares are the shares that we particularly go after.
But that takes high conviction. It really does. You've got to believe that the cycle continues. You've got to, one, trust management of companies. You've then got to really understand the sectors in which they're invested and the broader macro issues in which they operate to believe that that earnings, the good news will continue in perpetuity, or the bad news will continue in perpetuity.
Well, I mean,
if you go
we didn't just dream this concept up lying in the bath one day. I could point you towards a plethora of academic research which says the sort of the power of earnings revisions is extremely strong. And obviously we back tested in South Africa, and we came up with wonderful results there as well. But your point is a good one in the sense that there are different stages of the economic cycle as to what particular equity philosophies work better or worse. So, for example, in 2009, just post the depths of the global financial crisis, what works there, or in 2003, coming out of that recession, for example, is value managers do extremely well there. Okay, now why is that the case? Because share prices have generally been hammered at that stage, and the sort of valuation discrepancy is not that large. And then the market gets in its head that economic dawn is on the horizon, okay? Now why would you pay up for a share? Why would you pay a high premium for a share when growth is coming? Because any turkey can fly with a hurricane behind it, okay? So you go for the lowest shares. You go for the low PE shares. You go for the low quality stressed balance sheets, okay? So there's a definite period when value managers are going to sort of clean up, okay? But those are short in time duration. The majority of the cycle, be it economic cycle or market cycle, is the sort of intra sort of fall or sharp rise periods when markets grind upwards, and it's in those periods, in my opinion, where the value managers struggle.
Okay, but we're in that sort of space at the moment.
Correct.
Where, I mean, if you look at your own history, you must have had a time where consensus was for 10% growth in a company, and you went and did your sums, and you went, nah, this is 20% growth.
Right.
Do you go with the 20% conviction, and you then write the analyst report that gets everybody talking, or do you chicken out?
Okay, I stopped long ago writing analyst reports, but I get your point.
So particular.
In fact, sorry about that. I remember, in fact, years ago going to see Trevor Evans, who was then the MD of Nampak. Okay, now I was an analyst at that stage, and I remember I had a 10% earnings forecast.
Because everybody else said 10%.
Yeah, I think it was in line with the consensus, exactly. And I got a sense that Bevcan division was doing really well, okay, really well. So I should have come back to the office and changed my forecast from 10 to 20, in line with what you just asked. But I didn't have the courage to be so far away from the consensus. Okay, so I went from 10 to 13. Now at least I'm on the right side, I think, of consensus, because, in case I'm wrong. And then as time went by, I sort of stepped up my forecast. So just before they reported the results, I got to about 19%. When they came with 20%, I declared victory to my colleagues. Okay, and that is the behavioral bias which we seek to exploit. Is that people anchor to whatever their existing views were. My 10% I went in there with. B, they don't want to be too far away from consensus, because what if I'm wrong? Okay, and that is just, that is exploitable.
Okay, that's fine. In the next part of the show, what I want to do is I want to throw some shares at you, not physically, but just throw some names at you. And then I want you to tell me whether or not you're in the market to buy them. There's some pretty shares on some quite lofty valuations at the moment. We also have our studio audience. They will have some questions as well for Chris Freund, and we'll come back with those in just a moment. Part 2 of Tonight with Bruce Whitfield on this Wednesday evening. Earlier today, Chris Freund from Investec Asset Management joined us at the JSE, and with a live studio audience who we will mercilessly pick on in just a moment for their questions for Chris Freund. We put together tonight's program. I hope you're enjoying it so far. Chris Freund, I'm going to throw some names at you. Let's go for, I don't know, the world's most obvious sell, Naspers. On Friday, 3 bits of really good news come out on Naspers, mostly related to Tencent in China. Share price at one point was over 1,600 bucks. Is there anything to stop Naspers?
Bruce, nice that you picked on a nice sort of non-controversial share to start with.
Good. I'm so glad we agree.
But first of all, I think that Naspers's big jump on Friday, I mean, it's quite strange to see a really big share move 8% or 8+% in one day. But first of all, I think it had nothing to do with Tencent whatsoever.
Tencent did a deal where they're going to be distributing Warner Music in China, and then there were a couple of other announcements as well. How could it not be relevant?
Long term, that's ultimately good for Tencent. Tencent's share price in China on that day went up by 1.5%. So I'll give you 1.5% maybe of the 8.5% that was Tencent related. What happened on Friday was incredibly significant for Naspers, and I'm not sure everybody quite gets what actually was said on Friday. Is that Naspers is 3 businesses? Okay, it's the Tencent, it's the investment in Tencent, and as just everybody knows, Tencent is a business that makes and distributes games that you can play on your cell phones. Okay, and they sell them to zillions of Chinese customers that they have. The second business that Naspers has is the sort of the DSTV multi-choice business that you and I and many others pay monthly subs.
It's really worth it because you get great shows like this one. Yes.
I led with my chin there. And that's a good business. It's cash flows. It's a great business. The market knows. And the third sort of business grouping in Naspers is really 2 things. One is, you will know the website Gumtree.
Yes.
Okay, so the electronic classified businesses, and they've got, Gumtree's not their brand, OLX is their brand, but they've got sort of Gumtree equivalents in over 40 countries in the world. And they've got some what are called e-tailing businesses trying to sell goods and services on the internet. Okay, but let's just confine ourselves to the electronic classifieds business, because that's what was Friday's announcement all about. The problem is that they've been taking these cash flows from DSTV, the multi-choice area, and pouring that money into developing the sort of Gumtree equivalents, the OLX businesses, in a bit of a black hole. These are deep investment cycles that you go through for 5 years, and you may or may not make a cent. Okay, so the market's given that a 0 valuation for quite a long time. The Naspers share price has been covered just by its investment, the value of its investment in Tencent. Sure. So in large markets like Brazil, there have been 2 key players, them and a company called Shipstead. all right? And they've been killing each other. They both got about half the market, and they've both been investing heavily in sort of engineers and in programming skills, and more to the point, in marketing costs. And the thing about this electronic classifieds business, if you want to sell your second-hand surfboard on a website, and let's say you and I have both got websites, so you Naspers and I'm Shipstead. If I start charging you to sell your second-hand surfboard, you just go to
Absolutely.
the other guy's site, okay? But when you are the market, there's nowhere else to go, okay? And that's what these guys have just done. They said, let's stop killing each other. Let's actually join forces. We'll each take 50% of a joint venture. And people have nowhere else to go to sell their second-hand surfboard because we are the market. So the length of time that we as investors saw that Naspers would make money was going to be 5 years away if they were successful in sort of dominating that market, because you have to dominate in order to charge. All of a sudden, it became apparent that this funny verb that we use, monetization, would happen much, much faster.
So that was Friday's big announcement. Did you buy shares at 1,600 Rand?
No, we didn't buy shares in Seaton. We already had I'm happy to say, we already held a healthy slug of Naspers.
Should anybody be buying Naspers shares up to 1,600 Rand right now, based on this great evolution of the business?
Okay, so now this is where I'm really going to offend a lot of people in saying it. You could argue that Naspers is actually very cheap. And I can already see people's coffee mugs falling, around. But let me tell you, here's how it goes. All right. So first of all, Tencent, as I say, being the major investment which covers the existing share price, is on a forward P of 28 times. Now, that's not a dripping roast, 28 times. But when you go back and look at Tencent's long-term history, that is the average forward P over many years. Okay, so you can say, well, it's trading in line with its average forward P. And then what is the prospect for Tencent going forward? Well, you could argue that it's actually very good because they have these millions of customers on their Facebook equivalent product, WeChat and the Weixin, and they have a pretty good chance of converting quite a lot of those people who don't pay any money at this stage to actually paying some more money and to getting mobile revenues and things like that. So I'm not so sure. It's hard to argue that Tencent is cheap. I'm just not so sure it's easy to say, look, it's patently overvalued. But then, as I said to you, all the rest is for free.
Yeah.
So DSTV has got to be worth something. Okay, those cash flows that we all pay every month got to be worth a whole lot. Okay. And then we've seen this movie before. Well, what I described to you is just happened in this joint venture. We've seen this movie in Russia. There's a business called Avito. There, in fact, Naspers were the sort of a weak player in that market. They merged with the strong player, and the Russian market went from making big losses to very big profits quite quickly. And I think it's not an outside probability that those classified sites will be worth a hell of a lot of money in not too distant future. So look, it has gone up a lot in the short term. I'm not sure I'd be sort of piling into it right now.
Please pass Sir of the Salmon Tie a nice microphone. I told you I was going to pick on you. You were warned.
Chris, just a question around on the passive side, so outside of stock picking, which has been the focus. What can you, managing a balanced fund, do, especially in the bond and the property sectors, that a passive fund in the balanced space can't do? And what do you think of the increased kind of prevalence of passive balanced funds specifically in South Africa?
Great question.
Okay, first of all, in a balanced fund, someone's got to do the asset allocation, all right? So you could, I guess, have a static asset allocation, 60 equities, 20 bonds, 10 property, whatever, but that comes with pros and cons, and you forfeit the ability then to be in the right asset class at the right time. So first of all, someone's got to do the asset allocation. But more to your question about within, let's say, properties, do you go passive or do you go active? Now, we haven't given up on the concept of skilled property manager, for example, being able to beat the JSE property index over time. And in fact, I think we can demonstrate that this is possible. And clearly you have to do it after fees, but I think this is still possible as well. Within the bond space, it gets even more attractive because you get vanilla bonds, obviously government bonds, and then you get the corporate bonds. And if you get that blend right and you choose good quality corporate bonds, I think many people, many institutions have proven that they can beat the All Bond Index. In fact, most institutions have beaten the All Bond Index over the last couple of years. It was a question of how much you beat it by. If you only beat it by a little bit, your clients are quite cranky with you.
I'm going to ask you to throw share names at me in just a moment, and let's see if we can play that game. But very quickly, value traps. Because one of the issues and why many fund managers are not beating the index is because people are getting stuck in these value traps, particularly in commodity shares, where commodity prices have slid and continue to slide, and cheap shares keep getting cheaper, and performances are sucking.
Right. I mean, this is one of the issues that I have with a sort of a pure vanilla value-based investment, is that sometimes it can be, people use valuation as a crutch, in my opinion. It's so intuitively sensible that people default to it without actually giving it due thought in the case. I mean, the classic value trap that you referred to was Kodak, the company that went bust. The problem
didn't they invent photography? Practically
did, okay, but
didn't they invent digital photography?
But they looked cheap all the way down. At any stage of their demise, they looked cheap, okay. The problem is that if the economic fundamentals for that company are deteriorating as fast as the share price is, it's not cheap.
Yeah.
All right.
And goes with your philosophy, if the news is bad, it's going to continue being bad until
correct.
It's not bad
So
anymore.
you really, if you're a good value manager, have to be able to distinguish between genuinely periodically undervalued situations or this is never going to recover.
2 minutes for questions. Shout out a share. So with a nice tartan tie. Woolworths. You're not wearing a tartan tie, but that's okay. Woolworths. Most loved retailer on the market.
Okay, because you've got to love that management team. Those guys know what they're doing. And you come out of a meeting with the Woolworths management team and you want to rush back to your desk and put a buy order on at Woolworths. I mean, you just got to restrain yourself from doing that. Because they
If it's so good, why would you restrain yourself?
Well, first of all, it's a bit like the curate's egg. It's good in parts, not everywhere. All right. The clothing side, I think they would be the first to admit they have some. They could improve in that area. Secondly, the valuation is not that fantastic. Thirdly, and this is also going to upset some people, is that we are not entirely convinced that the acquisition of David Jones in Australia is going to be a startling success. It may well be a success in the end, but it may well take them longer than they think to introduce their house brands, to get them accepted by the Australian public, and for that turnaround to actually happen.
There are enough South Africans in Australia who miss Woolies who will support it. On that basis, there's an investment thesis. Give me a company. Any company? Sasol. Give me Sasol. 600 plus bucks the other day. Oil price below $80 a barrel. Sasol holding on just to 500.
Sasol's a tricky one right now. It really is. It's a good company. It's better managed now than it has been for quite a long time, in our opinion. If you look at the volumes that are coming out of the Sasolburg Synfuels plant, I mean, things are running better now than they have for many years, okay? That's the good news. The bad news is that the oil price is not doing so well. So you sort of have to pay as your money and take your chances whether you think the current oil price is sustainable at these levels or has further downside or, in fact, might recover somewhat. If the oil price doesn't recover from these, let's call it the Brent levels of $78 odd a barrel, then Sasol is going to get what we term downward earnings revisions. This is not what we look for. But we have a team of analysts, in fact, an oil team in London at Investec, whose full-time day job it is to consider the oil market. So they know more than I know about this. And we've spoken to them at length about this and the reasoning behind their views. And it's going to be quite important what happens on November the 27th. You might know there's a big OPEC meeting. Yep. And what Saudis say there. But the longer-term views from us and our team is that the oil price, in fact, will begin to recover. So Sasol is one of the few commodity shares we do own in the Discovery Balanced Unit Trust. Because you can't own no resources. You have to have a sort of a portfolio, a bit of diversification. It can't be an on-off switch. So shares like Sasol we do own still. Shares like Mondi we still own. We own very little Anglo-American, no Billiton, this fantastic company, not the right time in the cycle, and very little of the other resources companies.
One more company. Discovery. There's a good one. Are you, I mean, you manage Discovery funds.
I do.
Are you like the guys at Coronation who at $10 thought that Coronation was too expensive, at $20 it was too expensive, and now it's sitting close to 70, and they still don't have any inclined portfolios? Discovery hit 100. There was some confusion at the last results. The share price went down to about 80. It's over 100. It's 607 now, or thereabouts. Do you own much Discovery
Well,
portfolio?
first of all, let me tell you about a wonderful irony about Coronation, which you mentioned, is that one of the most successful investments we've had for Discovery Balance Fund over the last 12 months, it's still in our 12-month attribution as a really big positive contributor, was Coronation shares. We took a view that those earnings would continue to be revised upwards. We saw the flows going their way, and we made a lot of money out of it. We happen to have 0 Coronation shares now, which taking a view that story has played itself out. But it's a great irony that one of our competitors was really one of our best value-adding ideas in our clients' portfolios.
In 30 seconds, Discovery.
So Discovery is a fantastic company. Discovery Invest is growing like Topsy. Okay, so there are parts of the business that are doing extremely well. The core medical aid business is a fantastic business. It is high market shares, but the growth rates of this very high successful base are starting to slow down. And we had Discovery in our portfolios. We had a nice slug of it. We had over 2% of equity in it. And we've now taken it down. As the price has done so well, we've just taken it down to a neutral weighting now, which is just under 1%.
There we go. And at that point, I'm afraid we must leave it. I hope you got your companies answered. I want to throw one more at you. Let me throw Anglo Gold Ashanti.
Another nice non-controversial share. Thank you,
Yes, go on.
Bruce.
Let's finish on a high note.
So first of all, I think
30 seconds.
Okay, I think Venkat and his team are doing a fantastic job at Anglo Gold. I mean, they really are. They've taken a knife to the costs there and everything like that. But I'm not a big bull on the gold price. I happen to think that interest rates are going to stay low around the world for many years. I don't think there's any sign of inflation. If anything, there might be deflationary anxieties. So unless you believe the gold price is going to go up, don't have Anglo Gold in your portfolio. We've got a smidgen of Anglo Gold in our portfolios because in our view, it's the best of a bad bunch. But I wouldn't like to bet the farm on the gold price going up.
Interest rates tomorrow, South Africa. Today's inflation number, 5.9%. Rates stay flat tomorrow?
I think rates are going to stay flat tomorrow. I don't think it really matters that much whether they stay flat or they go up by 0.25%. This interest rate cycle is going to be benign, whatever the case, whether they raise rates slightly tomorrow or at some stage in the middle of next year. As you say, the inflation rate is going to come down. What do you say, 5.9% today? It's likely to go below 5% during the first half of next year.
We've nailed him to a forecast, and at that point, I'm going to leave it just on that particular point. Chris Freund was our guest this evening on Tonight with Bruce Whitfield. He's with Investec Asset Management. He runs 110 billion rands worth of other people's money, and I think you can tell why. He's got a deep insight into many of the big companies on the JSE. Ladies and gentlemen, if you'll please give him a round of applause as we say goodnight from the JSE. Bye-bye.